Hi, I'm Trey Booth, and today I want to talk about the sequence of return risk. When people think about retirement investing, they usually focus on average returns, but surprisingly, the order of those returns can matter just as much as the returns themselves. This is called sequence of return risk. Let's look at a hypothetical scenario. Let's say two retirees start with $1 million. Both take $50,000 per year and both average 6% per year over 5 years. On paper, those returns look identical. But if one retiree experienced market losses in the first few years of retirement, while the other experiences those losses later, the outcomes can be dramatically different. In this simple scenario over just 5 years, the returns cost one retiree almost $600,000 compared to the other. So why does this happen? Because in retirement, you're not just investing, you're withdrawing the money at the same time. If markets decline early while you're taking withdrawals, you'll be forced to sell investments when the prices are lower. That means you'll have fewer dollars remain invested to recover when markets bounce back. But if those same market declines happen later in retirement, your portfolio has already had years to grow, making it much easier to absorb those losses. So, what can investors do about sequence of return risk? There are a few ways we work hard to address this risk. First, we maintain a diversified portfolio, so you're not overly dependent on one type of investment. This allows us to hold on to investments that are down and sell something that is up to provide the funds that clients need. Second, it's good to have a plan that identifies when you will need to withdraw the funds. This allows us to have short-term spending needs covered by stable assets, so you're not forced to sell stocks when they're down. And third, having flexibility in withdrawals. This allows us to decide when to take the money, not necessarily what to take. And that really helps the market possibly recover and get back to your original cost basis before selling. The key takeaway is this. In retirement, it's not just about how markets perform, it's also about when those returns occur. That's why thoughtful planning becomes just as important as investment returns themselves. I hope you found this helpful. If you have any questions, please don't hesitate to reach out. Thank you.